Welcome to De-Risk, a podcast where we provide a no-nonsense analysis of stocks. Today, our research is taking us into the world of Lyft, ticker LYFT. Data is from this morning, September 18th, 2025. We're asking, is autonomous tech about to help Lyft floor it, or is the company, running out of road? Let's maybe start with the bigger picture, the macro environment. This morning, things look surprisingly green, especially tech. The Nasdaq's leading. Feels a bit like a risk-on day, doesn't it?
Yeah, it kind of does on the surface anyway. But when our research looks a bit closer, U.S. GDP growth, it's really slowing down. You're hearing more recession whispers getting louder. It feels like the economy's sort of running on fumes from, wealthier households. And we've got key jobless claims data hitting today. So yeah, we're definitely walking a tightrope. Short-term optimism, maybe, but longer-term anxiety is real.
Okay, so that slightly shaky background makes this Lyft news even more interesting. They just dropped a big announcement partnering with Waymo, a fully autonomous service starting in Nashville. Feels like a huge leap, strategy-wise. And our research backs that up a bit. Free cash flow jump, 169% year over year, and earnings are forecast to grow over 30% annually. Impressive stuff. But what's the street saying? Are analysts actually buying this vision?
Well, that's exactly where it gets fascinating, Ray, because there's a real conflict here. The Waymo news, yeah, that's positive, no doubt, but our research shows Wall Street is mostly sitting on the fence. Hold ratings dominate like 61% of analysts. And get this, strong buy ratings, they've actually gone down. Strong sell ticked up. And valuation estimates all over the map. Some say $21.60, others below $6. Meanwhile, the stock's trading at what, $22.84? So the market just seems torn. Is Lyft, this high-growth innovator, ready for the future, or has it kind of hit a wall with its current model?
So the pros are really split. What about the crowd? How are everyday traders betting? Our research points to a super bullish options market. The put-to-call ratio is just 0.27. That's pretty low. Means traders are snapping up way more calls betting the price goes up than puts.
Yeah, that low ratio definitely shouts bullishness in the options world. But okay, let's connect that to the bigger picture, because on the other side of the coin, you've got pretty hefty group of skeptics. Our research shows 16.24% of Lyft's the available shares is sold short. That's significant. So it's not just a small disagreement, it's a real high-stakes tug-of-war. You've got aggressive bulls in the options market, and this big, entrenched camp of bears betting directly against the stock price. Means things could get volatile fast.
Wow, okay. Aggressive options bulls, big short interest. How do you square that? Is one side just totally wrong, or does this just scream uncertainty?
It definitely points to major uncertainty. And, often the charts, the technicals, can give us another piece of the puzzle.
All right, looking at the price chart now, it looks pretty strong, powerfully bullish even, breaking out of old ranges. And the volume seems okay, suggesting money's flowing in, not out. Am I reading that right? Is that a healthy sign?
You are seeing the strength, absolutely. That trend is undeniable. But our research also flags some, let's call them signs of strain. That upward move has been fierce, maybe too fierce. The stock's deep into what we call overbought territory. It suggests it might need a breather, a pullback. And importantly, look at the last trading day. Big downward price move, right? And it happened on exceptionally high volume. That's often a classic sign of exhaustion. Like a lot of earlier buyers decided, okay, time to take profits, and they overwhelmed the new buyers coming in. Plus, volatility is high and it's actually increasing. So the stock stretched, kind of like a rubber band, increases the risk of a sharp snapback downwards.
Okay, so we've got growth potential, Waymo partnership, but conflicting analysts, this bull-bear tug-of-war, and now these technical warning signs. Where does all this leave us? What's the verdict from our research on Lyft?
So yeah, weighing all that evidence, our outlook is cautiously bullish. The main risks, as you pointed out, are definitely that big short interest, the sort of neutral stance from Wall Street analysts, and those technical signals suggesting the rally might be, overdone. The Waymo deal and the strong trend, they're undeniable positives, real tailwinds, but these exhaustion signs, they create a very volatile mix. Near term, say the next few sessions, the bulls really need to get back above $23.50 and hold it. Our invalidation point where we'd say the bears have probably taken over is if the price moves below yesterday's low, $21.91, and stays there.
So the ride ahead for Lyft looks anything but boring. It really makes you think, doesn't it? How much do you value an innovator on today's numbers versus that future promise, especially when the promise, like autonomous tech, is still finding its way? That's all for this deep dive. Remember, this is for informational purposes only. It's not financial advice. Always do your own research or talk to qualified financial advisors before making investment decisions. Thanks for tuning in. Catch you on the next episode.